This is the case of Roxas versus Court of Tax Appeals, a significant legal battle that delves into the complexities of taxation, property sales, and government persuasion in post-war Philippines. In the early 20th century, Don Pedro Roxas and Dona Carmen Ayala owned expansive agricultural lands in Nasugbu, Batangas. Upon their passing, these properties were inherited by their grandsons, Antonio, Eduardo, and Jose Roxas. To manage these assets, the brothers established a partnership known as Roxas y Cia. After World War II, tenants who had cultivated these lands for generations expressed a desire to purchase the parcels they occupied. The Philippine government, aiming to promote land redistribution, encouraged the Roxas brothers to sell their estates to these farmers. In response to governmental persuasion, the Roxas brothers agreed to sell approximately 13,500 hectares directly to the tenants. Due to the government's financial constraints, a special arrangement was made. The Rehabilitation Finance Corporation advanced 1.5 million pesos as a loan to Roxas y Cia, secured by the lands. The tenants would then purchase the land on installment, with their payments servicing the loan. In 1958, the Commissioner of Internal Revenue assessed Roxas y Cia for deficiency income taxes for the years 1953 and 1955. The assessment was based on the profits from the land sales, which the commissioner argued should be taxed as ordinary income, asserting that Roxas y Cia was acting as a real estate dealer. Challenging the assessment, the Roxas brothers contended that the lands sold were capital assets, and thus, only 50% of the gains should be taxable as capital gains. The case escalated to the Court of Tax Appeals, which upheld the commissioner's assessment. Unyielding, the Roxas brothers elevated the matter to the Supreme Court. On April 26, 1968, the Supreme Court rendered its decision. The court recognized that the sale was conducted under unique circumstances, primarily influenced by the government's initiative to distribute land to tenant farmers. It ruled that Roxas y Cia was not engaged in the real estate business. Therefore, the lands sold were capital assets. Consequently, only 50% of the profits from the sale were subject to capital gains tax. This landmark decision underscored the importance of context in taxation, acknowledging that the Roxas brothers acted in alignment with national land reform policies, rather than for commercial real estate profit. This was the case of Roxas versus Court of Tax Appeals, GR number L-25043, April 26, 1968. A pivotal moment in Philippine tax jurisprudence, highlighting the balance between governmental policies and taxpayer rights.